All right, well, welcome. I don't know what number this is of our spring gathering, but it's always it's a wonderful time for us because we get a chance to hear what's on your mind. And in a minute, I'm going to introduce a couple of speakers who will speak shortly, and then we'll open it up to Q&A, as is our normal custom. And I don't know, do we have some roving mics? Is that in the cards? Yes, we do have roving mics. We have two of them. Shannon's going to get one of them, and I don't know who's getting the other. But if you have a question, just hold your hand up. We'll try to get you a mic, and so everyone can hear what your question is, and we'll try to answer it as best as possible. I would like to introduce right now a couple of our topics that we're going to be talking about. In a few minutes, Drew Wilson will be coming up here, and he's going to be talking to you on volatility of the markets, how to embrace them as an opportunity. And as many of you know, as a matter of fact, I got this question outside. How do you go about investing money when you look at CNBC and the markets are up and then the markets are down? They're saying it's down for this reason, it's up for that reason. How do you do that? Well, we're going to explain a little bit how we look at that, and Drew will do that. And then Paul Hogan's going to come up. Last year, he reflected on the economy, the state of the economy last year, and how well the economy was positioned for growth last year. Well, he's going to do a little more reflection on that, but he's going to concentrate also a little bit on the recent tax bill and how that's maybe a catalyst for further growth, even though it seems like we've had a lot of growth up until now. So with that, I'd like to bring up Drew Wilson, and he'll talk to you about volatility.
So when we were deciding who was going to present this topic, I shot my hand up. I said, I've got a 17-year-old daughter, and this happens to be prom week, so I know a little bit about volatility. I'm living it. So tonight, in the last 3 or 4 months, Google searches for the term volatility have doubled since 5 years past. It's hard to open the Wall Street Journal or turn on CNBC without seeing volatility mentioned. And so we wonder why. Why is it top of mind? Why are we talking about it tonight? Why are we getting the questions tonight? Well, first of all, we have, after a long period of calm in the markets, we have seen volatility return in 2018. And as we're going to see, it's kind of returned in a big way. And volatility for many people is scary. When they see price swings, they get fearful. And in fact, for some people, it's actually painful, believe it or not. Behavioral psychologists have a term for this. It's called loss aversion. It's basically you feel 2 times worse for losing $10 than you feel good for gaining $10. So for some, it's actually painful. But there are a great many people who don't get scared with volatility or even feel pain with volatility. And we're going to look at, including us, and we're going to look at how you too might not only welcome volatility, but embrace it. So volatility for our purposes is wide swings in stock prices. And this is one way to look at that. This chart shows the number of days the S&P 500 moved up or down 1%, number of trading days. And one of the first things that you might notice is that volatility itself is pretty volatile. But what you see is here in this last couple of years, volatility has been low. The markets have been pretty calm. In fact, in 2017, we had the lowest number of trading days moving plus or minus 1% ever. It's about 3% of the trading days. But you see in 2018, with 4 months behind us, we've already moved 32 days of plus or minus 1%. That's almost 40% of the trading days. And if this trend were to continue, we'd have probably 95, 96 days, so matching 2011. So volatility is back. Markets are choppy again. Why? There are a number of reasons, and we're not going to go through them all tonight, but there are a few things that we can point out that we noticed when the market was doing fine in January, and then it started getting choppy. And the first thing we saw were signs of inflation in the economy. Not only labor, wages, but also materials, commodities, and transportation costs. And so when there are fears of inflation, there are fears that interest rates are going to rise. And both of those can be bad for stocks. Then we saw the trade tensions escalating with China and our NAFTA partners. That introduced a new round of volatility. And then at the end of March, we saw the Facebook scandal, which not only knocked Facebook's stock price down, but it also created this fear that the government was going to start regulating the technology companies. And they had been leading the market, so it created some more volatility. There's other things that have been happening since then, but these were three kind of milestones. Now, obviously, we have no idea if we're going to continue to be volatile. I personally wouldn't be surprised if 2018 and even in 2019 we continue to see volatility. So, is this new choppiness in the market, is it a risk or is it an opportunity? It's kind of the crux of the question. Many in the world of finance, and particularly in the world of academia, not only believe that volatility is risky, they actually define risk as volatility. This description below reads, volatility, if you can't read it, volatility measures the risk of a security. They are synonymous. Risk and volatility are synonymous. In fact, Wall Street has a myriad of products and strategies, all with the intent of just reducing volatility. We view things a little bit differently at Fenimore. This top part of this page is taken right from our webpage. And if you can't read it, it says, market risk. Fenimore defines risk as permanent loss of capital, not stock price volatility. In fact, price volatility may provide opportunities at a discount. And we're not alone in this view of volatility as an opportunity. One of the best investors that many people have never heard of, Seth Klarman, said, we steer clear of the foolhardy academic definition of risk and volatility, recognizing instead that volatility is a welcome creator of opportunity. And then maybe the greatest investor that everybody's heard about, that we and 40,000 other people spent time with this weekend, Warren Buffett, says the true investor actually welcomes it. So similar to what we believe about price volatility. So if this thing that's scary to so many people, and actually maybe even painful to so many people, how do you embrace that? How do we embrace that? Well, I've boiled it down to three key things. First, you have to know the value of what you own. And we're going to go through these in a second. Secondly, you have to understand that price does not equal value. And then lastly, and very, very importantly, you have to have a long-term perspective. So this is the lens, as Tom mentioned, this is the lens by which many people view investing and owning stocks in the stock market. Stocks are, to many, merely symbols crawling across the bottom of their CNBC screen, or green or red boxes up there in the heat map. Many people who own stocks maybe have an idea of what the business does, but has no idea what the value of that business is. So when they turn on CNBC and see their ticker at the bottom, or they get on the Yahoo Finance page and they see their ticker and it's followed by a big red down arrow and a big number after that, they're exposed to the price and they feel bad. They feel like, because they don't know the value, they feel like they've lost money. Fenimore, again, has a different perspective. You might have heard us talk about or write about our business-like approach to investing. So for us, when we buy a stock, we are buying, and we view it as buying an ownership stake in a business. And that business has a value. We call it intrinsic value. And although this looks like kind of an odd graphic, simply put, the intrinsic value is the sum total of what that business is going to earn over time. And that value cannot be known to the second decimal point, of course, because it's a prediction, but it can be estimated. And that's what the research team spends over 80% of our time doing. And that's not, to do that, it's not merely an exercise in spreadsheets. It's way, way, way more comprehensive than that. We look at the industry, we study the industry and all the participants in it. We talk to managements, the companies we own, and the competitors. We figure out what the competitors are doing and what they plan on doing. We look at the management teams that we own and what they're doing about cost cutting, or how they're going to grow. Are they going to acquire? How are they protecting margins? And very importantly, how are they protecting capital and redeploying the capital that we have bought in our ownership stream? And this is hundreds and hundreds of man hours that we spend for the sole purpose of knowing the value of what we own. I was in Tucson last week, or a couple weeks ago, and I saw my first ever Roadrunner, so I think that's why I named it Acme Company. They say a picture is worth 1,000 words, and this picture, this graphic, encapsulates all three aspects, all those three keys of embracing volatility. The blue line is the intrinsic value, that value we saw on the page before, and the red line is the stock price. One of the first things you might notice is that stock price is not the value. The stock line is not the value line. Price does not equal value. Value, in fact, is a lot more stable. The value of business is a lot more stable than the price of a stock. The second thing you might notice is that even though they are different, over time, the price of a stock tracks, the growth in the price of a stock tracks with the growth in the value of the business. But over short periods of time, any number of things can affect the price of a stock. We've seen stocks fall on the Facebook scandal, Fed press releases, Trump tweets, any number of things that have very little to do with the value of the business. So the key to it is if you know the value of what you own, and you understand that the price that the market is offering you every minute of every day can have little to no correlation with the value of that stock, and the price of that stock gets volatile, you get an opportunity that in fact can be very rare, and that's this opportunity. It's very rare that a great business, the quality businesses that we're looking for, sells at a steep discount to what it's worth. When you get an opportunity, the only way you get that opportunity oftentimes is to have a volatile market or a volatile stock price. So when you buy it here, not only do you get to benefit from the growth in the intrinsic value of the business, but you also get to benefit from the closure of that gap from here to the line. So that's what we call margin of safety, and very often you cannot have that without volatility. So know the value of what you own, know that stock price and value are different, and very importantly, you have to have a long-term perspective. And with those things, volatility is not only not scary, but it's very welcome. So those are the three keys. And now that you know the keys, what else can an investor do in an environment of volatility? Well, first, probably very importantly, and I know that our great private client group will help you with this, but you got to have a reasonable long-term financial plan based on reasonable assumptions. And that should be the yardstick of your progress, not daily, weekly, monthly, or even yearly movements in the stock market or your stocks. And secondly, because in the short term, the stock market can be volatile, any money that you might need in the next couple of years, you shouldn't have in the stock market because you don't want to be forced to pull it out and take a loss if you don't have to. You got to keep long-term money in the stock market. And thirdly, part of that long-term plan might include a balanced account of both stocks and bonds. We have a lot of clients, and we have a great, Jesse, where's Jesse? Jesse runs our bond portfolio. We have a lot of clients that really benefit from having a combination of stocks and bonds in their portfolio. Very importantly, debt, leverage. Not only in your personal financial situation, but also certainly in your investment account. Not having margin keeps you out of a lot of trouble. And then lastly, this is something that we talk about a lot, is dollar cost averaging. And that is just dribbling the same amount of money in the market at a specified or at a constant rate. You might hit some of those highs, you might hit some of those lows, but over time you have a very good investment experience. So with that, hopefully you too will embrace volatility.
You really can get the sense that Drew loves volatility. He gets very excited about that. So I'm going to talk a little bit about the current market environment, and I'll tie that into the new tax rate that we see that corporations are paying. And I thought I would talk a little bit about a year ago. So a year ago, I was making a presentation to a group in Cooperstown and talking to them about what we do and how we do all our own research and the different products that we have, and you know all that. So I'll just talk a little bit about what I was thinking about the market back then. So last year, 12 months ago, the sales growth for companies in the S&P 500 were growing about 5%. So that's decent top-line growth. Earnings were growing twice that, so earnings were growing 10%. That's fine. The economy is growing, that's showing up in stocks. And we also saw that because the economy was growing, capacity utilization was also growing. Capacity utilization, that's just measuring a factory. If it's outputting more this year than it was last year, then utilization is up, and that's a good thing. We like to see that. And with the economy growing, wages were just starting to increase. We've been looking for that for a long time. And inflation was low, but it was starting to come up. And up to that point, we were talking a little bit about deflation, and that's a very bad thing. We don't like deflation at all. But we're starting to see inflation, and that's a good thing. And also interest rates were low, so funding things was not that difficult to do. So as John said, yes, interest rates are low, credit is easy, but losses are likely to go up from here. So the credit quality was about as good as it was going to get. And confidence was at a pretty good rate, so we liked that. So that was really a very good backdrop for investing. So fast forward 12 months to today, we have sales growth that is about 8% in the most recent quarter for the S&P 500. So it's gone from 5% to 8%, so that's a clear acceleration. We like that. And earnings growth has gone from that 10% last year to 25% this year. Yes, I said 25% this year. How can that be? Well, the reason for that is the new tax law. We're seeing that corporations are paying a much lower tax rate, dramatically lower. So along with that, the economy is growing. Capacity utilization is up even more than it was last year. That has accelerated. Wages are growing, and that has accelerated, albeit from low levels. Inflation is picking up. Drew talked a little bit about that inflation. And even though inflation is picking up, it is really just now hitting the Fed's target inflation rate of 2%. It's only 2%. So inflation is low. Interest rates are rising, but they're still relatively low. Funding costs also are not that expensive. And as John would say, right, losses are likely to go up from here, which is fine because they're about as good as they get right now. So, and energy prices. Energy prices are rising, but they're not prohibitive. So it's not that expensive for someone to fill up their car or pay for their heating oil or their natural gas. So that's all good. But on top of that, when you look at the confidence numbers, that's really where we're seeing a huge boost in the economy. So consumer confidence is up about 10% over last year. And when I look at that and I tease out more details, CEO business confidence, so these are the leaders of business, they're about 7% more confident now than they were 12 months ago. And when you look at small business, their confidence is near an all-time high. And the last time it hit this level, you had to go all the way back to 2004, where it peaked out, and then it declined for a number of years. It bottomed out in 2009, 2010, and it's been a long road back, but it's really accelerated in the past year. We look at job openings, and that is at a new all-time high, and again, you had to go back to 2004 before you saw where it was at these levels. And then the NFIB, they put out a survey and they ask a question, is now a good time to invest? And they're talking about investing in their own business. And the answer, the number of people answering yes to this is at a 30-year high. Unbelievable. So the backdrop really continues to be very good for investing. And I know I can see some of you in the audience are about to raise your hand, but what about North Korea? What about Israel? What's going on there? What about Iran? And what about, steel prices are going up, and what about all these things? Oh, and valuations. You said valuations last year were high. They've got to be higher now. And yes, all those things are true, but we don't think that those things are what derails the long-term growth of the market. Yes, there might be volatility, which is going to make Drew very happy because he likes volatility. But we think that really there's a counterbalance to all those things. And what is that? That's the new tax law. And what this tax law is it means that corporations, they pay a federal and a state rate. The federal rate has gone from 35% down to 21%. So if I'm doing my math right, that's a 40% savings. I'll take a 40% savings on anything. So that's really terrific. And I'll give you some examples of how that really benefits the companies that you own in your portfolio. But just as a policy standpoint, why are lower tax rates good? In economic terms, if you want more of something, you tax it less. If you want less of something, you tax it more. All right, let's put this in terms of something that we've heard over the last several years. Electric vehicles. We want more electric vehicles on the road because they're cleaner. We want more windmills. Well, how do you incentivize behavior to get more of something? You give tax breaks, right? You lower the taxes. Well, what do we want less of? Dirty coal, maybe? Okay, so how do you get less dirty coal? You tax it more, okay? So there's the economic application of taxing things more, you get less. Tax it less, you get more. All right? So we've been living in this world where we've had fairly high corporate tax rates. In fact, the US tax rate for corporations was among the highest in the world. And that's not the position anybody really wants to be in. And that has led to a lot of distortions. And in fact, it put US corporations at a distinct disadvantage. So how is that? Well, if a US company is competing against a foreign company, and that foreign company has half the tax rate of the US company, that foreign company can price its goods and services at dramatically lower prices than the US company. And at that lower price, they can make the same earnings and the same return on invested capital that the US company can have. So there's a great example of why a US company was at a disadvantage. Also, this led to tax inversions. And this is where companies, US companies, they would buy a company in Europe that would have a lower tax rate, and then they would move the company over there and they would take that tax rate. So the net effect of that is US companies were moving out of the US into foreign countries. That's not good policy. And then the third disadvantage was that cash that companies would earn would get stranded overseas. So these companies, they would have to pay those high corporate tax rates if they bring it back. So what they were doing is they could borrow at 4% in the US and leave the cash overseas, and that borrowing was backed up by the cash over there. But that's actually bad policy, because if you do this for year after year after year, you start seeing companies where their balance sheets get over-levered, and then they can't borrow anymore. So it's not great policy to do that. So now we have this new lower tax rate, and it has many benefits. So really, to sum this up, the investment environment remains very favorable. Yes, volatility is a little bit higher, but we can deal with that. That gives us opportunity. We have the wind at our back from this lower tax rate, and that's driven a lot of employee bonuses. It's driven higher wages. It's driving more employment. Companies are investing more in their businesses, which is all positive, and that spurs greater economic activity. Every aspect of the economy drives activity. And then, as Warren Buffett says, that this is going to be a tremendous tailwind to the US economy. So that's the guru. You've heard it from the horse's mouth right there.
I want to introduce the research team that just sat down there, and you know most of them, but I think it's good to go over what they do and how valuable they are to us. First, John Fox, who is the Chief Investment Officer of our firm and also co-manager of the Value Fund. John's been an immense help to me throughout the years, and he's a great leader of the team. He really is. And Paul Hogan sits next to him, who you just heard from. Paul has been with us a long time too, and he is the co-manager of the equity income fund for us and our equity income strategy, our dividend growth strategy. And then next to Paul is Will Preston. Will's one of the newer analysts in the firm. Will came to us from the University of Albany, so he's a local graduate here, and we like to get a lot of our people from the college system around here. Actually, we had an intern program, and we still do, and Will was a product of that, and then he went to work for another firm, and we were able to entice him away from the other firm and bring him back. So that's good news for you. He's a bright guy. Drew Wilson is next to him, and Drew is a co-manager also of the Value Fund. Helps John out a lot. They argue a lot. I don't know exactly what they're arguing about, but I see them arguing about certain things. They have different points of view about investing, but that's okay. That's healthy. That's good. That helps us make the right decisions. And lastly, Kevin Joya. Kevin is another local graduate, came to us from Siena, and we've had a lot of interns out of the Siena program, and they've all been very, very good, but Kevin's top of the heap. Kevin helps out in our small cap product with Andrew Board, who is not here. Andrew is the one who is in Memphis, and I think he's traveling today, taking some of his kids or getting some of his kids from college or whatever. Andrew has about 9 kids, so who knows where he is. But there's one thing we know about Andrew. With 9 kids, he's going to be with us a long time, believe me. So at any rate, having said that, I actually would like to kick off this Q&A session with a little bit of a story, because I think it's very illustrative of a lot of the things that we do, and it's very illustrative of why we go to Omaha every year. Somebody said it's like going to church. You know what you're going to hear, but you need to hear it from time to time. And Warren started out the meeting this year. He started out the meeting with a little analogy, a personal analogy of himself. And he went back to when he was 12 years old. Going back to 1942. And when he was 12 years old in 1942, he actually held up some headlines from New York Times newspapers. And if you looked at the headlines, the Japanese were about to take over the Philippines. They were on their way to Australia. The Nazis had just closed all the ports in Norway. We had the European theater and the Pacific theater, and world was pretty tenuous back then. As a matter of fact, very tenuous. But Warren, being 12 years old, was watching this company called City Services Preferred. Now it's a preferred stock, so it pays a dividend. And he'd watched it for a while, and it was selling at one point at $80 a share. And it had fallen to about $40 a share, and he went up to his dad, who was a broker, and he said, Dad, I want to buy 3 shares of this. And his dad said, son, don't you know what's going on in the world? You just read the headlines and all that. He said, no, Dad, I want to buy 3 shares. So he bought 3 shares, and it was selling, I think he bought it about $38 a share. And he showed the graph, the graph of the price of the stock going down, where he bought it, and it went down from there, which is kind of normal for value investors. We never get the bottom right. It went down from there, and then, but about a year and a half later, the City Services called the preferred, to get rid of the preferred issue. And it was called at $200 a share. And you can say, okay, well, gee, he made a great choice. Unfortunately, as Warren said, I bought it in March, and I sold it in July, and I made $5 on the trade. So he said, I learned 2 lessons there. He said, first of all, be very patient and hold on for the long term. And secondly, he said, even though the world seems to be chaotic and everything, You want to kind of ignore what's going on and pay attention to what can happen. Now, he gave an example. He said if you had $10,000 and invested in 1942, and you could invest in a market like in a market index, he said, what would you have today? The answer is you would have $51 million. And he said the only decision you had to make was that America would do well. And you would end up with $51 million. He also went on to say that you could have invested, because things were a little tenuous, you might have been a little fearful about what's going to happen. You could have taken the $10,000 and bought gold. You would have ended up with 300 ounces of gold. Now that's nice, he said. You could take it out at night, look at it, you could rub it in your hands, and it would feel pretty good probably. He said, but what would that be worth today? That would be worth $400,000. So you would have made 100 or more times your money by sticking to one decision: believe in American business and the American economy. And that's a lesson that we have to hear every single year, because it's a truism. So his point was that you're much better off investing in productive assets that earn something, whether that's stocks or businesses that earn something. It might be real estate that earns something. It might be a farm that earns something. You're better off investing in productive assets than in non-productive assets. Gold doesn't produce anything. You can hold on to it, but it doesn't produce a thing. So that's my message to start the Q&A. And so now we're going to open it up to you. So don't be bashful, just raise your hand. We've got a mic. Mic's going around.
You talked often about the intrinsic value. How do you determine that as a person like myself? The second question I have for Paul, and that is with the tax cut, which I'm in favor of, it seemed to me that it was out of whack to go down all the way from 35 to 21. Would have made a lot more sense in terms of the deficit. And what is this deficit going to do for us? Thank you.
I'll start.
Yep.
Am I on? So the description of what we do to calculate the intrinsic value of the business, a lot of times Buffett, who says the same thing, he says it's simple, but it's not easy. So I think it's very, without doing some of those man hours, some of those things that we talked about. But the thing is about looking at the industry, buying a good business, one that grows, that's got high returns on capital, that makes a good cash profit, that's got good management team and a very clean balance sheet. Those are the filters that we use. And when you filter out everything else and start with that, you already have a huge advantage. And then figuring out the intrinsic value from that point is almost all of the information, or a lot of the information that we use is publicly available. The companies provide it on their websites. You can actually get conference call transcripts of everything that they say to us. You can read yourself. And of course, it does require, even though I said we don't spend all the time in the spreadsheet, it does require some calculation about what that earning stream is going to look like. So you just have a range of guesses and you hazard a guess and you get a nice range of what you think that business is worth. It's, for a complicated business, we put it in the too hard pile. It's got to be a business that we can predict, a cash flow stream that we can predict.
Yeah, I think the main phrase there is cash flow. So if you think about how do you value real estate, right? You have a building, people pay rent, you get the rent, you pay your expenses, there's cash left over. And so people think about, what type of rate of return they want for that cash. If you have a farm, it's got so many acres, you can grow so much corn per acre, you can sell it for so much a bushel, you know what your costs are, how much cash profit do you have after that. If you buy a bond, right? You get interest. And so you buy a bond for $1,000, you get $20 a year of interest, and then you get your money back at the end, right? So every investment, including a company, is how much cash does it generate? So you've heard us talk about a lot over the years about we like, not just profits, we like cash profits. And so just like a farm or real estate or a bond, as Drew was describing, we look at a company, the CDW that Paul mentioned, and we look about how much cash do they generate in a year, and we try and figure out what it's worth based on the cash profits that it generates.
Yeah. These guys build elaborate models and so on and so forth. And, really the intrinsic value is really the present value of the future cash flow stream, the discounted cash flow of that future cash flow stream. And Warren says this all the time. And then Charlie says, well, you've never calculated that present value. And it's true, he never has. So you have to have some knowledge of what some knowledge of what it's probably going to be. So you're not going to do that on a business that you don't really understand. And we know that all the models we build are wrong. We just know that. So.
Well, I have a phrase, I have a lot of phrases I use in the office, as these guys will attest to. I have one that's called the illusion of certainty. And, we'll pick on Drew because he brought it up. Plus, I love to pick on Drew. You'll run this spreadsheet model, we all do, and you come and say the stock's worth $80. Well, might be worth 75, might be worth 85, might be worth 90, But if you can buy that in the market at 65, okay, it's a pretty big gap between 80 and 65. That's the margin of safety he referenced. So, we know that 80 is not the exact precise number to 2 decimal places. We know that, but we try and get a range for what the business is worth, and we use a number of different methods, one of which we're describing about the cash flow. That's the main one. And you get a sense what something is worth. You can look at where it's traded in the market over time. So it's getting a sense. There's no exact number to 2 decimal places, and you can't. So I think that's a caveat. I think that's what Tom's trying to say. You can get a sense over time.
And a funny John story on top of that. Thank you. They really do try to hammer that in very early on. When I was an intern back 8 years ago in 2010, first day I sat down in John's office, and he wanted to teach you the importance of focusing on the cash flow. So he asked me one simple question. He said, do you want to get paid in GAAP earnings or do you want to get paid in cash? And well, I wanted cash. And so that was how I knew that that's what we needed to focus on with the companies. And that was just sort of just the way we think about it and the mentality that he kind of delivered home very early on in my building as an analyst.
That was the right answer.
Yeah.
And George, in part 2 of your question on the tax, the jury's out as to what will happen with the deficit. Will economic growth offset the projections on the deficit? We don't know. But we also know that in this country, we spend a lot of money on things that we don't necessarily, they're nice to have, don't necessarily have to do that. And to the extent if the deficit gets too overblown, will that focus Congress's mind towards not spending as much money? We don't have a revenue problem, we have a spending problem. So that's how I look at it. But all else being equal, if you really wanted to be fair, a zero corporate tax rate would be the fairest among all corporations. Companies that were operating overseas would pay a lower tax rate than a company that only had a few stores and only sold in the US. A zero tax rate would equalize everything. So if you're coming at it from a fairness standpoint, zero is the number. And I'm not saying that from any political persuasion. I'm just saying that the math of that's how it works out.
John, you talked about the intrinsic value of a company. Say it was $80.
Yeah.
And that's a guess maybe with 2 or 3 points.
Well, I don't like the use of the word guess, but go ahead.
Now, at what point do you make a decision to buy that stock? At 65 or 68 or Or do you want to, how about 72? What makes you, where do you say, let's go?
Well, we'd like a discount,
Of course.
and it varies based on the quality of the business and the quality of the management team. So if we, there's some businesses that are just phenomenal, or, they have growth, they're differentiated, they don't have competitive pressures, they have a long track record of growth, they have returns on capital in the high to mid-teens, they generate a lot of cash, and they don't need to put a lot of cash back in the business. That's the best profile, and we'll pay more for that.
Okay.
And then we interview the management team, and we go out and meet with them, and we're just like, boy, these guys are terrific. They're, one of the best managements that I know. So under that type of scenario, there's less of a discount.
Right.
We might pay a 10% discount in that type of situation. If there's more uncertainty, management's good, but they're not phenomenal. Maybe we're worried about competition. We might pay a 20 or 30% discount. So it depends on our sense, of which sometimes we're wrong, but it depends on our sense of the quality of the business, the strength of the competitive position, and the quality of the people that are running it.
Tom, after the way you savaged gold as an asset class, I assume you feel the same way about cryptocurrencies?
Cryptocurrencies, that's an interesting topic. It's been, Bitcoin's been widely in the news, and different cryptocurrencies and so on. I said to someone earlier that it's pure speculation, and I fully believe that. Charlie Munger put it a little bit differently. He said it was idiotic. So, take your choice. Either one. It's pure speculation. There's nothing like supporting. It's a non-productive asset. There's nothing supporting it except supply and demand.
Yeah, if you think about, what we kind of got in the topic today, intrinsic value and cash flows and what's the farm worth and what's the business worth and all that type of thing. There's no cash. It has potential value as, people are worried about paper money and inflation, and it's not controlled by the government and all those type of things. Will it be a store of value? I have no idea. But for us, there's no cash for us to count. So it's just not the type of thing that we can value. And if we can't value it, then we really can't invest in it. So, and you can see, the price was going up, and it hit 20,000, I think, and I don't know, what is it now, Will? 8 or, yeah, and it's not in the news anymore. So I remember in 1999 with technology stocks, I had a saying, people are only buying them because they're going up, and when they stop going up, people will stop buying them, which is way more profound than it sounds. You got to think about it. And so far, the experience with Bitcoin has really been similar. It was, a lot of excitement was going up, and now, it's down 60% from the high, and you don't see a lot about it. But it's just not something that there's no intrinsic value. There's no way to estimate intrinsic value for us, and so we really can't be involved with it.
Paul, this is a tax question for you. With companies that have large cash balances overseas because of the tax situation, what actually triggers the tax when they bring it back here? Is it the physical transfer of cash, or is it something more subtle?
Okay, so I'm not a tax expert, but yes, so the companies before, what they would do is they would pay the tax. Say they had a facility in Thailand, and they're selling something in Thailand. Thailand has a 12% tax, for example. So the company would pay the 12% tax. When they brought the cash back to the US, that's what would trigger them to have to pay the 35% federal and whatever state they would tax that was on top of that. So that's what would trigger it. And so now it's a different system.
There's a tax at a lower rate overseas, 15% or 15.5%, and you can use the money anywhere in the world. Doesn't matter. So it allows companies to bring that money here and to use it here for the benefit of the shareholders.
The question was, how do we find companies that are worth investing in? And it's a good question. There's a number of ways. We read a lot. We read investment newsletters. We read all different periodicals, things of that nature. We attend investment conferences. They can be conferences where all types of different businesses show up from different industries. And their CEO, CFO tell the story, and we have to judge whether or not we should learn more about that business. We referenced going to Berkshire. You'd be surprised to hear that there's a lot of people at the Berkshire Hathaway meeting that are interested in long-term value investing. So we've met a lot of people over the years. They sometimes have great ideas for us. And then one of the other great ways too is to, if there's a company that we think is interesting and we start doing work on them, perhaps we'll find out that one of their competitors is an even better business when we're doing our research. So those are kind of the main ways we tend to find stuff.
And we all come at it a different way. So that's where having the team that's very collegiate, we can put our minds together, and when we come up with a new idea, we put a green sheet together, and it's a 70 pages.
When do you decide to sell a company after you've made enough money? When do you decide that?
Oh, to sell?
Yeah, to sell.
Oh, okay, well, let me finish this, and then we'll talk about the sell. So we send around this report to everyone, and everybody submits questions on that, and just to make sure that we're not missing anything. And then if it hits our price, we'll buy it, and that's the process. On the sell process, Kevin, do you want to take that one too? Kick that off?
Sure. We discussed a lot about intrinsic value today. There are times when a great company can sell in the market for far more than what it may be worth at the time. If we still love the business, we'll likely hold it, but we'll maybe sell some of our position. And then there's times where we have an investment thesis, and a lot of that rested on what management's plans were for the business, and perhaps management just did not do what we thought was going to happen, or different things happened to the business, and the investment thesis didn't work out, and then that's what we call the sad sale over time. But to be honest, I don't think Tom wants us to sell anything if we can help it over time. So we don't really like to sell too much if we can help it.
Yeah, our tendency is to hold on. But what you'll typically see in a stock that really appreciates a lot probably becomes a bigger part of the account, right? Let's say they all start at 3 or 4% of the account. Well, one that's really, really done well probably grows to 6 or 7%, right? Because it's done better than the other ones. And so normally you'll see that size position, we'll cut it back. Maybe it gets to 7%, we'll bring it back to 4. We typically don't sell it out completely, but we will typically cut it, reduce the size of the portfolio. And if he remembers Drew's slide where he had the blue line, right, where the value of the company was going up, and the red line was like this. When the red line's way above the blue line, that's when we start working on it and say, hey, this looks expensive, let's revalue it, and if we think it's expensive, then we'll reduce the position size. But our tendency, which has been very good over time, is if you have a great business with very well managed, is to hold on.